Our previous analysis, as you might recall, focused on Red Cat Holdings. Today, we're shifting our attention to Astronics Corporation. They're an aerospace and defense company in the industrial sector based out of East Arona, New York.
Right. And the timing here is, well, it's pretty critical. Astronics has been, frankly, an absolute market darling recently. The stock's trading near its 52-week high, boasting a performance year-to-date of over 217%. I mean, that kind of exceptional momentum really demands scrutiny.
Absolutely, it does. So the central question we really need to grapple with today is whether this undeniable recent momentum and the huge projected growth, are they firmly supported by sustainable fundamentals? Is this a legitimate cyclical recovery? Or is the current surge, especially when you look at the valuation metrics, maybe signaling an overheated, possibly speculative price? I'll be presenting the case that this momentum is justified, driven by, a structural shift and some solid strategic execution.
Okay. And I will be articulating, let's say, the necessary concerns regarding the company's valuation multiples, the persistent issues with trailing 12-month profitability, and the significant latent risk profile that's just inherent when you rely so heavily on forward guidance, especially when the current financials look, frankly, quite compromised.
Well, from my perspective, I see Astronics demonstrating a powerful and I think legitimate recovery. It's driven entirely by its core market, aerospace commercial transport. And this conviction, you can see it reflected quite clearly in the projected financial trajectory. The strong sales recovery is evidenced by a massive EPS growth projection for next year, 37.58%. That results in a forward price-to-earnings ratio of about 22.30. Now, that seems strategically reasonable, I think, for a company that's clearly exiting a deep cyclical trough. Furthermore, the company seems to be executing perfectly. You see that with strategic acquisitions like Bueller Motor Aviation and Envoy Aerospace, which really enhance its crucial aerospace segment. And look, the market, the analysts, they seem to agree. The consensus recommendation is a 1.00 strong buy, with a target price that confirms confidence in future results.
That focus on future projections, however ambitious they might seem, it feels like it completely ignores some serious current financial deficiencies. Despite this really remarkable stock price run-up, Astronics currently reports significant negative TTM profitability. We're actually looking at a TTM EPS of negative 0.16 and net income of negative $3.73 million. But the real concern for me is the fundamental inefficiency. We see negative returns right across the board. That means the capital they currently employ is, it's actively destroying value. You see that evidenced by the negative returns on assets, equity, and invested capital, the ROA, ROE, and ROIC.
If the underlying business is genuinely turning around, aren't those negative TTM metrics just, historical noise at this point?
Their current reality, though, and that reality creates profound tension with the valuation. The multiples are stretched. Significantly stretched for a company that isn't currently generating a profit. The enterprise value to EBITDA stands at an alarming 34.06, and the price to free cash flow is 50.83. This just indicates the market is pricing in multiple years of robust, absolutely flawless execution perfection, really, years in advance. And compounding this, the intrinsic value estimates, they range dramatically. You see figures from $10.85 using a discounted cash flow model all the way up to over $68.21. Honestly, when valuation models spit out a range that wide, it tells you less about the company itself and more about the extreme uncertainty that's baked into those future growth assumptions. And that's reflected, isn't it, in the dismal D rating for its value style score.
Okay, I understand the point about the range, but I'm not convinced by that line of reasoning regarding the valuation multiples themselves. Because the high EBITDA, it's mathematically a bit misleading in a cyclical recovery like this. How can we view the forward PE as stretched when they are clearly exiting a cyclical trough? That high multiple is fundamentally a function of the denominator, the EBITDA, being severely depressed from the downturn. The market is clearly anticipating an acceleration based on very specific segment strength, and we have empirical evidence for this. They already reported record aerospace sales back in Q2 2025.
But how can we just ignore the persistent negative margins while simultaneously assuming flawless execution going forward? The profit margin is negative 0.45%, and the operating margin is only 4.27%. That high EBITDA of 34.06 is based purely on the hope of future earnings, which introduces massive execution risk. And we know that lingering supply chain pressures and labor shortages, these are identified risks to their operations. Relying solely on future profitability when current fundamentals show this kind of capital inefficiency, it introduces significant fragility because every single quarter they miss that ambitious projection, the premium they've built into the stock becomes incredibly vulnerable.
The market is investing in the rate of change. We have to recognize that the 458.70% EPS growth projected for this year shows we are already moving sharply out of that loss-making phase. The forward-looking EPS for next year shows profitability is expected to return robustly, and that projection validates the high growth and momentum scores, which, receive a B grade. The very reason the EPS growth is projected at 37% next year is precisely because those current constraints you mentioned are expected to ease, allowing the massive existing backlog to translate into revenue more efficiently.
Let's maybe shift the focus slightly then from operational risk to, let's call it, contingent financial risk, because these two factors, they really collide on the balance sheet.
Actually, I think the company's overall balance sheet health mitigates many of those financial risks, in my view. We see a current ratio of 3.04 and a quick ratio of 1.63. I mean, that's classic, textbook, excellent short-term liquidity. It suggests they can easily meet their current obligations. Furthermore, management has been proactive, quite proactive, in managing the capital structure. They secured a new $300 million revolving credit facility and issued $225 million of 0% convertible senior notes. And the debt-to-equity ratio, at 0.72, is certainly manageable. It suggests structural stability and, importantly, strategic flexibility.
While those liquidity ratios do look robust on the surface, I think they are immediately offset by the clear and present threat of significant pending litigation liabilities. This is sort of the shadow balance sheet we just cannot ignore. Astronics has already been ordered by a UK court to pay approximately $11.9 million in damages to Lufthansa Technik AG for patent infringement. And remember, that figure is in addition to the previous $4.5 million paid in a related matter.
But the appeal for that $11.9 million judgment isn't expected until early 2026. So this is not some final figure that has to be paid tomorrow. The market is clearly betting on either a favorable outcome on appeal or perhaps a drastically reduced settlement. Otherwise, the current price performance would simply be impossible to maintain with that hanging over them.
But even with an appeal pending, the liability is known. It requires legal resources, potential provisioning. These multi-million-dollar liabilities, and let's not forget there are also ongoing copyright infringement claims with Teradyne. These have to be weighed very seriously against the current debt load and the perceived stability of the balance sheet. Look, for a company that currently reports a negative net income of under $4 million TTM, the cumulative risk of a, $16 million plus settlement, that's substantial. It just introduces an unquantifiable shadow over the very financial forecast that your argument relies so heavily on.
I think the market is clearly discounting those historic intellectual property issues in favor of the growth opportunities ahead. In a sector that deals with multi-billion-dollar airframes and long-term contracts, the market often views these kinds of disputes as, manageable operational friction. It seems already discounted rather than a fundamental threat to the going concern. Let's maybe look at who else is making decisions about value here, ownership and sentiment. That's often quite telling about management confidence, wouldn't you say?
Well, I come at it from a different way when looking at ownership and particularly insider behavior. While institutional ownership is indeed high, showing broad external interest at 86.43%, the insider net transaction flow is negative 4.14%. And we have observed significant sales by key directors, notably Robert S. Keem. He executed substantial share sales in May and March 2025, right when the stock was soaring toward its high. That kind of selling, near the peak, It signals, to me at least, some skepticism about the sustainability of the current valuation from those who should know the most about the company's internal challenges.
But isn't that perhaps a secondary consideration when the primary driver, the near-record backlog, is just screaming recovery? Let me offer a different perspective. Insider ownership does remain substantial at 15.60%. That demonstrates significant alignment between management and shareholders' long-term interests. Furthermore, focusing solely on the director sales kind of misses the forest for the trees, the core driver of the stock price today, which is the undeniable sector recovery.
But this negative insider sentiment, you combine that with the company's heavy reliance on the commercial transport market, which, let's remember, counts for about 70% of revenue. That presents a deep, structural, cyclical risk. We saw exactly how devastating that proved during the pandemic era, didn't we? It resulted in massive layoffs and significant write-downs. That sensitivity to global air travel cycles remains a long-term vulnerability that, yes, management appears to be capitalizing on right now, but perhaps not adequately hedging against for the inevitable next downturn.
But currently, right now, that reliance is their major strength. It's fueling the strong recovery and the near-record backlog you mentioned. The entire aerospace sector is recovering strongly, driven by things like fleet renewal and replacement schedules. The company's exceptional performance, which is reflected in its high beta of 1.63, is really just a reflection of successfully capitalizing on this upcycle. And the strategic acquisitions they made in 2025, they further solidify their market position precisely in this growing commercial transport cycle. That demonstrates they are prepared for the scale and the demands of this recovery. I'd argue they are structurally positioned to capture this demand. So the debate ultimately centers on valuing strong and, I believe, justified momentum. It's fueled by an accelerating aerospace cycle and some smart strategic capital maneuvers. The forward-looking projections and the strong analyst consensus really support the current upward trend, positioning Astronics for substantial earnings improvement as it moves firmly out of the recent cyclical trough. And that, I think, makes the 22 times forward PE a reasonable premium to pay for this kind of high growth potential.
The market's enthusiasm is, well, it's undeniable. As evidenced by those performance metrics, I concede that. But the underlying financial data remains highly volatile. The combination of negative TTM profitability and, frankly, inefficient capital usage alongside those stretched valuation multiples like the 34.06 EV/EBITDA, and then you add the ongoing specter of multi-million-dollar litigation liabilities. It strongly suggests that investors are accepting an exceptionally high risk premium for this projected growth. The material, when you look at it closely, clearly presents a high-stakes trade-off between potentially immense growth and profound intrinsic value risk.